Form 1065 is the major tax form required for partnerships and LLCs. They're for informational purposes only, since no taxes are paid with the return. Nonetheless, the IRS requires them to be filed on a timely basis. Each year the partnership is in business, Form 1065 must be prepared and filed by the 15th day of the third month following the close of the partnership's tax year. For a calendar year partnership, this is March 15th. I want to spend some time summarizing the tax forms used for partnership and LLC taxes. The partnership is not a taxable entity, but it reports the partnership operations in a two-step process. Most ordinary income and expenses generated by the business activities are first netted together to produce a single net income or loss amount. This is reported on Form 1065. The second step reports other income and expense items that must be computed separately on the K-1. All tax items are separately reported to each partner on a K-1, such as those for ordinary business income or loss, those for capital gain or loss, those for portfolio or investment income, and partner net earnings for self-employment. Each partner reports his respective share of tax items on his individual income tax return. The partners must treat such items in the same manner as the partnership treated them. This other income could be affected by various exclusions, deductions, and credits at the partner level and must pass through for proper tax treatment by each partner. While some partners can deduct the entire expense, for example, others may be limited in what they can deduct by the amount of their adjusted gross income or another limitation. Form 1125A determines the partnership's cost of goods sold if the partnership sells merchandise as part of its business operations. If an exception applies, the cost of goods sold can be accounted for as incidental materials and supplies rather than inventory as they are sold. Schedule B is a list of questions that require a yes or no answer or additional information about the partnership. Schedule K is a critical form because it is a summary of all partnership tax items and is the link between Form 1065 and the partner's pro rata share on Schedules K1. The amounts on Schedule K are apportioned among the partners according to the partnership agreement. This is another good reason for having the partnership agreement in writing. Schedule K can be confusing because it includes income and deductions that are separately and non-separately stated, informational items, as well as gains and losses. But after you spend time working with Schedule K, you'll begin to see how everything works together for partner-level reporting. Schedule L is a statement of the partnership's financial position or accounting-based balance sheet. The Schedule L balance sheet should agree with the partnership's books and records. The taxable income shown on the tax return takes tax laws into account and may differ in key ways from the client's bookkeeping. The differences are accounted for on Schedule M1, which reconciles book income with income shown on the tax return. Schedule M1 begins with book income and ends with tax return income. The reconciliation process ensures that certain items of income and expense not included in the partnership's books and certain items of income and expense not included on the tax return are accounted for. Examples include a 50% disallowance for meals and entertainment, included in tax deductions but not book deductions. And it also includes tax-exempt income, included in book income, but not taxable income. Schedule M2 reconciles all the partners' beginning and ending capital accounts. Schedule M2 shows what caused the changes in the partners' capital accounts during the tax year, as reflected on the partnership's books and records. The amounts in the capital account analysis on each partner Schedule K1 must equal the aggregated amounts on Schedule M2. Now let's discuss self-employment tax for partners. If the partner is considered a general partner, the partner's distributive share of partnership income is generally subject to self-employment tax. Guaranteed payments and ordinary income from business activities allocated to general partners are subject to self-employment tax calculated at the partner level. Limited partners are not subject to self-employment tax unless they have guaranteed payments for services actually rendered. As a result, the partnership pays no federal income tax. Rather, the partner's individual tax liabilities are affected by the entity's activities. If a partnership makes a payment on behalf of a partner, such as alimony, medical expenses, or other items that normally constitute itemized deductions to individuals, the partnership treats the payment as a distribution or guaranteed payment to the partner, and the partner then determines whether a deduction may be claimed. If the partnership pays accident and health insurance premiums or medical and dental expenses, the partner can claim their premiums on Form 1040 subject to some limitations. Note that they are not deductible against self-employment income tax. If, however, the premiums take the form of a reduction in distributions to the partner, then the premiums are considered part of the partner's distributive share of income and are not deductible by the partnership. To summarize, Form 1065 is the form that is used to report income and expenses for partnerships and LLCs. As a professional tax preparer, you will need to become familiar with this form. It may seem complicated at first, but experience in using and preparing the form can be a quick teacher. As with all the tax forms, you will become more familiar with the intricacies of partnerships and LLC tax issues as you gain experience with each form. Your workbook includes a line-by-line description of the form. My experience has been that most partnerships are relatively straightforward, making this form much easier to complete than it appears when first looking at it. Frankly, 80% of partnerships report less than $100,000 in sales, demonstrating that they are fairly simple organizations indeed. Therefore, most of what is covered in the workbook is for the more sophisticated 20% of partnership returns. Now we will move on to corporate tax returns.